When it comes to personal finance, many people believe that you need a large amount of money to build wealth or make smart financial decisions. But the truth is, even a small, consistent investment, like $100 per month, can completely change your financial future if used correctly. At the same time, products like whole life insurance are often marketed as all-in-one solutions that combine protection, savings, and investment. This raises a powerful question. Can a simple $100 per month strategy actually outperform whole life insurance? The answer, when you break it down step by step, is not only surprising, it's eye-opening. Today, we will talk about this $100 per month strategy beats whole life insurance every time. So, before we start, make sure to hit the like button and subscribe to my channel. Let's start by understanding what whole life insurance is designed to do. Whole life insurance provides lifelong coverage along with a cash value component that grows over time. Part of your monthly premium goes toward the cost of insurance, while the rest is allocated to a cash value account that grows at a guaranteed rate, sometimes enhanced by dividends. On the surface, this sounds like a great deal, protection plus savings in one package. However, here's the first major truth. Whole life insurance is not optimized for growth. A significant portion of your premium, especially in the early years, goes toward fees, commissions, and administrative costs. This means that your cash value builds slowly at first. Even over the long term, the average return on whole life policies tends to fall in the range of 3% to 5% annually. While this growth is stable and predictable, it is relatively low compared to other investment options. Now let's introduce the $100 per month strategy that changes everything. Instead of putting $100 into a whole life policy, imagine splitting your approach into two simple parts: buying affordable term life insurance for protection and investing the remaining money into the stock market, specifically in low-cost index funds or ETFs. This approach is often referred to as buy term and invest the difference, and it's one of the most widely recommended strategies in personal finance. Here's why it works so effectively. Term life insurance is incredibly inexpensive compared to whole life. For many people, $10 to $30 per month can secure a significant amount of coverage. That means you still have $70 to $90 left each month to invest. Now let's look at the numbers. If you invest $80 per month in a diversified stock market portfolio with an average annual return of 8% over 30 years, that investment could grow to over $120,000. Increase the contribution slightly or extend the timeline, and the numbers become even more powerful. In contrast, putting the same $100 into a whole life policy might result in a cash value of $50,000 to $80,000 over the same period, depending on the policy structure and performance. This difference is driven by one powerful force: compounding at higher returns. Stocks have historically outperformed most other asset classes over the long term. While they come with volatility, they offer significantly greater growth potential. Whole life insurance, on the other hand, prioritizes stability over growth, which limits its ability to build substantial wealth. Another key advantage of the $100 per month strategy is flexibility. When you invest in stocks or funds, you have control over your money. You can increase or decrease contributions, change your investment strategy, or access your funds if needed, with some tax considerations. Whole life insurance, in contrast, is a rigid structure. Premiums are fixed, and accessing your cash value can involve loans, interest, and potential penalties if not handled carefully. Liquidity is another important factor. With investments, especially in brokerage accounts, you can access your money relatively easily. With whole life insurance, it may take years before your cash value grows to a meaningful level. In the early stages, surrendering the policy can result in losses due to fees and surrender charges. But let's address something important: risk. Critics of the $100 per month strategy often point out that the stock market is unpredictable. And that's true in the short term. Markets go up and down, and there are periods of decline. However, history has shown that over long periods, 20, 30, or 40 years, the market has consistently trended upward. The key is staying invested and not reacting emotionally to short-term fluctuations. Whole life insurance, by contrast, offers stability and guarantees. Your cash value grows steadily, and you are protected from market volatility. For some individuals, especially those with low risk tolerance, this can be a valuable feature. But this stability comes at the cost of lower returns and reduced flexibility. Another factor that makes the $100 per month strategy so powerful is behavior. By separating insurance and investing, you gain clarity. You know exactly what each dollar is doing. One part is protecting your family, and the other is building your wealth. This separation helps you make better financial decisions and avoid the confusion that often comes with bundled products like whole life insurance. Taxes also play a role in this comparison. Whole life insurance offers tax-deferred growth and tax-free access through policy loans if structured properly. However, long-term investments in stocks can also be tax-efficient, especially if held for extended periods. Capital gains taxes are typically lower than ordinary income taxes, and strategies like tax loss harvesting can further improve efficiency. One of the most overlooked advantages of the $100 per month strategy is scalability. As your income grows, you can increase your investment contributions significantly. That $100 per month can become $200, $500, or even more over time. Whole life insurance, however, is less flexible. Increasing contributions usually requires purchasing additional policies or riders, which can be costly and complex. Another important consideration is opportunity cost. Every dollar you commit to a whole life policy is a dollar that is not being invested in higher return assets. Over decades, this difference compounds into a substantial gap in wealth. This is why many financial experts argue that whole life insurance should not be the primary vehicle for building wealth. Here's an additional insight that strengthens this strategy. Consistency matters more than the amount. Even if you can only invest $50 or $100 per month, the habit of investing regularly builds momentum. Over time, as your income increases, you can scale up your contributions. What starts small can grow into something significant, simply because you stayed consistent. Another overlooked benefit is simplicity. The $100 per month strategy is easy to understand and easy to follow. There are no complex structures, hidden fees, or confusing projections. This simplicity makes it more likely that you will stick with it long enough to see results. That said, whole life insurance is not useless. It has specific use cases where it can be valuable, such as estate planning, wealth transfer, and providing guaranteed financial support for beneficiaries. For high-income individuals who have already maximized other investment options, it can serve as a conservative, tax-advantaged asset. However, for the average person starting with $100 per month, the priority should be growth and flexibility. This is where the simple strategy of term insurance plus investing shines. It provides the protection you need while maximizing your ability to build wealth over time. The real takeaway is this: you don't need a complex strategy or a large amount of money to build wealth. You just need a simple plan, consistency, and time. Small actions repeated over years lead to powerful results. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.